Today is Monday, October 29th, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. Today's guests are Steve Freed, Vice President of Grain Research at ADMIS, and Alan Bush, ADM Investor Services Senior Financial Economist. Steve, let's start with the grains this morning. Please provide our viewers with an overview of what corn, soybeans, and wheat have done in the month of October.
We've been range bound. Nearby soybeans started the month at 8.57. They went up to 8.92. They went down to 8.44, and today they're trading at 8.56. Corn, nearby corn was at 3.65 on the first day of October. Went up to 3.78. Went down to 3.60. Now at 3.68. And wheat, nearby December wheat, we started at 5.09. It went up as high as 5.27, went down to 4.85, and now we're trading at 5.07. So we're trying to stay within these ranges with conflicting bullish and bearish news.
So what are the key fundamentals for prices at this time?
Right now we're winding down the harvest. The dollar strength continues to offer resistance. We still have no resolution to the U.S. and China trade deal. For the most part, bean and wheat exports have been less than people had hoped, while corn exports have been better. Farmer reluctant seller, and South America is starting out with good crop conditions.
Can you tell us where the funds are now and where do you maybe see prices heading?
Well, right now the funds are short 60,000 contracts of beans and 30,000 contracts of wheat, and long about 20,000 contracts of corn. I think beans are overpriced and they should go lower, and I think the corn prices are going to try to bounce a little bit after harvest. Wheat prices probably will follow a little bit to corn prices and try to move a little bit higher off these prices.
So what do you think farmers should be doing right now with their 2018 crop, and should they also be looking at marketing their ungrown 2019 crop? Should they be buying put options for unsold cash grain? What are your thoughts there?
Well, first of all, Hightower recommended them buying a soybean January put today at 8.15 strike price, looking for maybe a 39-cent gain in the put as the market trades lower. I think market farmers right now are frozen. They expect prices to go higher, especially in the beans if there's a resolution to the China trade. So they're willing to pay the storage and bet that over the next 6 months prices are going to go higher. I think that for the most part, though, I would sell my 18 cash, replace it with a call down the road if necessary, and I'd be aggressive in selling especially beans for 19.
Steve, can all farmers do that? Are lenders, wanting the farmers to sell more cash? I mean, or does it just depend on each individual's situation?
I think that what we're hearing is that there's probably a little bit more sold to date than normal, and we think the bankers might be involved in that, trying to lock in some of these prices and so that they don't extend their debt. Most farmers, though, I think, let's say 30% of them are in a good financial situation, where if they wanted to trade options, they could. The others, the bankers might be reluctant in lending them money to trade options, but I think that it's a good risk investment to try to maximize some of your return on investment and minimize some of your risk.
Yeah, let's turn toward the financial markets. There are additional signs of slowing economic growth in China. What is your outlook for the Chinese economy?
Well, it still appears that China's economy is going to continue to weaken. There's, in fact, some additional information today suggesting just that I think there's more pain ahead for Chinese economy. So nothing has changed. It looks like it's going to continue to weaken.
The 30-year Treasury bond futures here in the U.S. traded higher on Friday in spite of the stronger than anticipated GDP report. What's the outlook for interest rate futures market now?
Right now it appears that we may have hit some type of bottom in the interest rate futures markets. We did see some very severe declines in the 30-year bonds since the middle of 2016. But I think now we've probably seen this bear market running its course. So I would just look for a sideways trade. Any shorts that you have on now, I think I would cover at this level. And I think the main reason is that the Fed will not be raising rates aggressively next year.
Yeah, there's been some recent comments that make traders believe that the Fed may be backing off some of next year's interest rate increases. If the Federal Reserve is slow to hike the Fed funds rate next year, how will this affect stock index futures?
Well, first of all, we've already seen one Fed official, Kaplan, late last week talking about the need to be less rigid in a predetermined path for raising interest rates. So if that continues, and I think it will, and I believe there will be other Fed officials basically saying the same thing, that they cannot be quite as aggressive in hiking rates in 2019, that would be very supportive to the stock index futures. And I think that will be what ultimately rescues this bull market in stock index futures across the board.
Alan, one final question. The volatility in the stock market, daily swings of 500 points in the Dow futures. Is this volatility, in your opinion, here to stay?
I think it is here to stay. There's a big divide as far as opinions on this market. There is a lot of rhetoric and a lot of articles saying the bear market is here, and they actually have some interesting reasons. But I think none of them are compelling enough to outweigh the still low interest rate environment that I believe will be the influence that dominates and ultimately takes the indices to higher levels.
A lot of people are uncomfortable with this level of volatility when they see the swings and see 300 and 400, 500 point down days. What kind of advice can you give those long-term traders, when they face this type of volatility in the market?
Well, it absolutely necessitates, I believe, the traders should be scaling down their numbers, taking on less risk, maybe using more options. It does appear that the volatility is going to be with us for quite a while. So scaling back numbers, I think, is the first thing to do.
But it's not you don't have an opinion that would say to liquidate stocks at this time.
No. This is a correction only. The bull market is still intact. Breaks should be used as buying opportunities. You might look for maybe larger breaks after some type of congestion, but in keeping with the volatility. But this is not a top. This is not the major top for the indices, and I think we'll see some new highs across the board next year in all of the major stock index futures.
Very good. Thank you both. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.